The stock market is like a giant, bustling marketplace where people from all walks of life come together to buy and sell pieces of companies, known as stocks or shares. Imagine it as a huge network connecting investors, businesses, and even entire countries, all exchanging value and ideas in real time. When you own a stock, you actually own a small part of that company. This means you share in its successes and sometimes its struggles. If the company grows and earns more money, your stock's value can rise, rewarding you for your investment. But if the company faces challenges, your stock's value might fall, reflecting those tough times. The market's daily ups and downs are like a heartbeat, reflecting how investors feel about the future of the economy. These changes are influenced by news, world events, and even the emotions of millions of people making decisions at the same time. A rising market, called a bull market, signals confidence, optimism, and economic growth. People feel hopeful and are willing to invest more. On the other hand, a falling market, known as a bear market, suggests caution and uncertainty as investors worry about the future and may pull back. Millions of people invest in the market to grow their savings for important goals, like retirement, paying for a child's education, or buying a home. The stock market offers a way for everyday people to build wealth over time, even if they start small. Indices like the Dow Jones and S&P 500 act as report cards for the economy, showing which industries are thriving and which are struggling. These indices help us track the overall health of the market and spot trends that might affect our investments. By watching the market, people can make smarter, more informed decisions about their money. Whether you're a seasoned investor or just starting out, understanding market trends can help you plan for the future and avoid costly mistakes. The stock market isn't just for Wall Street experts or big institutions. Anyone can learn from the market story. With the right knowledge, even beginners can participate, learn, and benefit from investing. In many ways, the stock market acts as a daily pulse check on the nation's economic health. It reflects the hopes, fears, and ambitions of millions, and its movements can impact everything from job opportunities to the price of groceries. That's why the stock market captures our attention day after day. It's not just numbers on a screen, but a living story that affects us all. On Friday, December 26, 2025, the U.S. stock market wrapped up the day with a slight decline, closing a few points lower in what was a notably quiet post-holiday session. The atmosphere on Wall Street was subdued, with the usual hustle and bustle replaced by a sense of calm as the year drew to a close. Trading activity was light, as many investors and traders were still away or working reduced hours following the holiday break. This lull in participation meant that the market was more sensitive to even minor shifts, resulting in a gentle dip rather than any dramatic swings. Losses were seen across several key sectors including consumer goods, oil and gas, and utilities. Each of these areas experienced modest declines, reflecting a broad but shallow pullback rather than a concentrated sell-off. The dip in consumer goods stocks suggested that investors might be growing cautious about future consumer spending, possibly due to concerns over inflation or changing economic conditions. Meanwhile, oil and gas shares slipped as oil prices edged lower, influenced by both global supply factors and reduced demand during the holiday period. Even utilities, which are typically considered a safe haven during uncertain times, saw their values decline. This indicated that some investors were looking to reallocate their portfolios in search of better returns, rather than sticking with traditional defensive plays. With trading volume so low, even relatively small buy or sell orders had a noticeable impact on prices, amplifying the effect of otherwise minor market moves. The overall mood among investors was one of caution rather than fear. Many were taking a step back to review their positions and consider their strategies for the upcoming year, rather than making any hasty decisions. There were no major headlines or breaking news stories driving the market's decline. Instead, it was a combination of small pressures, like end-of-year portfolio adjustments and lingering economic uncertainties, that contributed to the day's modest losses. As the closing bell rang, the market's losses remained modest, setting a subdued and reflective tone for the final trading days of the year. Investors seemed content to wait for the new year before making any big moves. In the end, it was a day defined by small adjustments and quiet reflection, rather than any dramatic developments, a fitting close to a calm, post-holiday session on Wall Street. The Dow Jones, S&P 500 and Nasdaq are the main scoreboards for the market. On December 26, all three finished slightly down. The Dow slipped just 20 points, a tiny 0.04% drop, showing a nearly flat day for big companies. The S&P 500, tracking 500 top U.S. companies, dipped by only 2 points, again, a fractional move. The Nasdaq, home to many tech giants, had the biggest drop at just 0.09%. These small changes show a market treading water, with no clear winner between buyers and sellers. For most investors, such minor shifts have little long-term impact. The day reflected indecision, not a major trend. The market ended almost where it began, as investors looked ahead to year's end. The day's decline was led by consumer goods, oil and gas, and utilities. Consumer goods fell on worries about future spending. Oil and gas dropped as crude oil prices slid, reflecting concerns about global demand. Utilities, usually a safe haven, also slipped, suggesting investors weren't overly fearful, just shifting money around. Not every sector was down. Some retail and material stocks did well. The market saw a mix of winners and losers, leading to a nearly flat result. It wasn't a broad sell-off but a rotation between sectors. Investors balanced their bets, creating a slightly negative outcome overall. The VIX, or fear gauge, measures expected volatility in the S&P 500. On December 26, the VIX ticked up slightly to 1360, still very low by historical standards. A low VIX means investors expect calm. A high VIX signals anxiety. The small rise matched the market's tiny dip, showing mild caution but no panic. The VIX is like a market mood ring. On this day, it barely flickered. For most people, a small VIX move is just normal market noise. Big spikes in the VIX mean trouble, but this was just a gentle ripple. The market's mood was cautious, not fearful. The fear gauge confirmed a quiet, uneventful trading day. Even on a flat day for the overall market, some individual stocks can make surprisingly big moves, catching the attention of traders and investors alike. While the major indices might not show much action, beneath the surface, there's always a story unfolding. Sometimes dramatic, sometimes subtle, but always worth watching. On the Dow today, Nike stood out as a leader, posting a solid 1.5% gain. This move could reflect renewed optimism about consumer spending or positive news from the company. United Health also saw its shares rise, adding to the positive momentum among blue-chip stocks and signaling some strength in the healthcare sector. Meanwhile, McDonald's and Disney both slipped, though their declines were modest, less than 1%. These small drops might not make headlines, but they're a reminder that even the biggest names can face headwinds, whether from shifting consumer trends or broader market sentiment. In the S&P 500, Target jumped over 3%, likely fueled by strong holiday sales numbers and upbeat forecasts for the coming quarter. On the flip side, Moderna dropped nearly 5%, as investors reacted to news in the biotech space or concerns about future growth. These moves show how quickly sentiment can shift, especially in sectors sensitive to news and earnings. Palantir Technologies also fell, reflecting ongoing weakness in some tech and healthcare names. The tech sector in particular has seen increased volatility lately, as investors weigh growth prospects against rising competition and changing market conditions. Over on the Nasdaq, volatility was the name of the game. A SPAC called 3 Acquisition soared nearly 79% in a single session, while Investicore plunged 65%. These dramatic swings are a stark reminder of the high-risk, high-reward nature of certain stocks, especially in the world of small caps and speculative plays. These kinds of moves can create both excitement and anxiety for traders. For every big winner, there's often a big loser, and fortunes can change in an instant. It's this unpredictability that keeps the market dynamic and engaging. While the main indices appeared calm and steady, individual stocks told a much more volatile story. Beneath the surface, there's always a flurry of activity, with some stocks surging and others tumbling, often for reasons unique to each company. The market is really a collection of thousands of unique stories, each stock representing a different business, a different challenge, and a different opportunity. It's not just about a single trend, but about the diversity of experiences and outcomes that make up the market each day. Big winners and losers don't just move prices, they shape the day's narrative, influencing how investors feel and what they focus on next. These stories often set the tone for tomorrow's trading as well. Every stock's move, no matter how big or small, contributes to the bigger market picture, reminding us that the market is always more than just the sum of its parts. Some stocks hit major milestones like 52-week or all-time highs and lows. Freeport-McMoRan reached a new 52-week high, reflecting strong demand for copper and gold. A SPAC 3 acquisition hit an all-time high after its massive surge. These highs signal strong momentum and investor enthusiasm. On the flip side, Investicore, Aptevo Therapeutics, and Greenland acquisition hit all-time lows, showing deep trouble. New highs can trigger FOMO and more buying. New lows can spark panic selling. These milestones are psychological markers for investors. They highlight the most extreme stories of success and failure. Highs and lows are the exclamation points in the market's daily story. The stock market is closely tied to commodities like gold and oil. On December 26, gold surged 1.35% to a record high, as investors sought safety. Oil prices fell over 2%, reflecting worries about global demand and economic growth. The drop in oil hurt energy stocks, while gold's rise signaled caution. The US dollar also strengthened slightly, making American goods pricier overseas. A stronger dollar can be a headwind for big exporters. These moves in gold, oil, and currency markets help explain the day's sector shifts. Rising gold and falling oil painted a mixed picture of investor sentiment. Commodities and currencies are key pieces of the market puzzle. They influence which sectors rise or fall on any given day. Why care about a small dip in the stock market? The market reflects the health of the economy, which affects jobs, prices, and interest rates. If you have a retirement account, your savings are tied to the market's long-term growth. Small daily moves are normal. Don't panic over them. The key is to focus on the big picture and stick to a long-term plan. Diversification, owning a mix of stocks, helps manage risk. Index funds make it easy to spread your investments across many companies. The day's small dip was just a blip in a much bigger story. Stay informed, be patient, and keep your eyes on your long-term goals. The market story is about persistence, not daily drama.